thing that we never learned in school is finances. How to deal with finances, what to do, how to improve your finances, and we wanted it to be something that you couldn't necessarily do, and we wanted to learn from one another and teach each other. So we got all of the professionals together who we know, and the best agents who we know to talk about finances so we can help them.
I'm Britt McLaughlin. I'm team leader of She Moves Philly, along with my business partner Brittany, who's not here, and I'll be moderating the panel tonight. If you have any questions, save them for the end, or tap me or pull my shoulder or something. But we'll try to work everything in if we can. Obviously, we're starting a little bit later. So everyone, if you can just take a moment to introduce yourself, describe your role and responsibility, and here's the fun one: how do you get paid? So once you tell us what you do and who you are and where you work, if you can tell us like how that position gets paid, I think that's always a burning question that everyone has. So can we just start from the end?
Absolutely.
Okay.
So my name is Isaac Lawbaugh. I'm a financial advisor with Northwestern Mutual. Although I work with Northwestern Mutual, I'm actually a 1099 employee, so I'm a broker-dealer. So statutory employees, technical side of things, we have employee benefits, but that's neither here nor there. I've been with Northwestern for 10 years now. It's all client-facing, so I meet with individuals or business owners on a one-on-one basis, talk through what their financial goals are, where they're currently at, what they're trying to accomplish, and then create detailed plans to show you how do we get from point A to point B most effectively. So then how do I get paid for it?
Yeah.
So I get paid a couple different ways. It's all commission based. On the insurance side of things, whether I place a product with Northwestern Mutual or any of the other insurance companies that are out there, they pay me directly. I'm sure that it's built into the premiums somehow, but I don't have a clue how that works. But they pay me. You guys don't pay at all for any of that side of things. And then on the investment side of things, there's basically two different platforms for investments. There's basically transactional type accounts called brokerage accounts, and then advisory accounts. Advisory is just a fee to manage the money. The brokerage ones are transactional charges. So that's in essence how I get paid.
Can I just, I'm going to interject.
Yeah, for sure.
By show of hands, how many people are in the real estate industry? Yeah. And then if you're not, do you own your business? Just curious of how people, own your businesses. And what do you do?
I work in HR.
HR. Okay. Just curious so that they can help answer questions a little more effectively. Like we're not all real estate people here, so sorry.
No, that's perfect. Yeah.
Okay. My name is Corrine Johnston, and I'm an accountant with a firm called Engage CPAs. And I've been my first 3 years out of school. I worked for a small accounting firm, and then I've been in the startup world for a couple years, and then I've been with Engage for about 1.5 years. So how we get paid, or I'm a salaried employee. We do have a profit sharing plan that's quarterly. Just basically, it's based off of our growth, and there's a baseline that's set, and then however we exceed that growth in that quarter is a little bonus that I would get at the end of the quarter. The firm itself gets paid. We provide like subscription based for our clients. So we work with all small businesses in the Philadelphia area, a lot of realtors, a lot of creatives in the area, and most of our clients will sign up on. We sometimes we call it a monthly retainer, but it's also like a subscription. There's no contract, and basically you can sign up to meet us 2 times a year, 3 times a year, or 4 times a year, and then your subscription would increase on a monthly basis. So each client of ours gets charged once a month for our service, and you'll never see a rate increase. You'll basically be at a fixed rate for the entire year, and it's just billed monthly to all of our clients. So that's basically
Does that change based off of complexity of taxes?
It changes based off of what type of business you are. So if you're a single member LLC or just a sole proprietor, that's just one tax return for you. So there would be a set rate for that, and then depending on whether you were a biannual, a triannual, or a quarterly subscription, the rate could go up a little bit. We do, depending on certain clients, we do some bookkeeping for them as well. But if you owned it, a partnership or an escort, that would be an additional tax return. So we would build in that fee into your subscription for the month. So it depends, but for the most part, it's all small businesses that we kind of work with. So.
All right, hey, everybody, we ask questions now or after?
At the end, if that's okay, unless it's like something that you're like, I'm gonna forget and you want to get it out. Good.
Fair
Right.
one, fair we payroll.
For weeks, okay.
We don't do payroll. No, we kind of work more in like the consulting role for a lot of our clients. We do prepare the tax returns. We just finished our busy season 2 months ago. But a lot of what we do is really looking at our clients' numbers, and we do a lot of the cleanup of their books too before we meet with them, and then really just game plan for the year, for taxes, and also just for the future, what the client wants to get out of their business, and short and long-term goals is really what we try to achieve with them.
Hey everybody, my name's Jake Snow. I'm a mortgage advisor at Corrine State Home Loans. So what my daily activities consist of, we'll kind of back up here a little bit. Primarily just supporting our referral partners, right? So primarily realtors is who we work with. We're 100% referral based, but we do work with CPAs, financial advisors, all that stuff. So what that consists of, it's primarily pre-proven buyers, right? Setting expectations, educating clients, right? Making sure that they're comfortable with costs, different stuff, right? But other stuff, we attend settlements, primarily just to support for that client, make sure they're comfortable with everything, but also for our referral partners too as well. So whether that's marketing material, as I've already mentioned, settlements, pretty much you call me, whatever I can help you to do to be more successful as one of our partners is really what my role focuses on. To educate you a little bit more on my pay structure, it's a little bit different than the more traditional way that a lot of folks think about the mortgage business. So to kind of wind the clocks back a little bit, prior to Dodd-Frank 2010, everything was based off of revenue, right? Every loan officer was paid based off of revenue for how much they closed on the deal, right? Dodd-Frank changed that stuff. So you're primarily paid in 3 different ways, whether it's units, salary, or volume. My compensation is kind of the newest, pool of thought for how to pay loan officers, which is a combination of a salary. So I get a small salary, and then I'm also unit based. So I have a tier system that I'm based off of. If I close X amount of units per month, I get bonuses out based off of those units, right? So obviously, motivated by closing more units and helping more buyers. However, the consistency of the salaries is definitely helpful. Whereas kind of more traditionally, it's based off of 100% commission, which I think that Alyssa's going to touch upon here in a little bit. And so I was chatting a little bit more with her about what her pay structure is, but a little bit different for me at Garden State Home Loans. So we're kind of doing things a little bit more.
I think the key factor I'm trying to get out of how do you get paid is how does that affect the consumer? So
Sure.
I don't care that you're making salary, that's cool.
Right.
But how much gets charged to the consumer,
Sure.
right?
Yeah.
Is it built into the mortgage cost? Where does that fee look like?
Right. So if you want to understand how the company gets paid, it's based off of volume, right? How I get paid is based off of units. So whether you bring me a client that's buying $1 million house or a $50,000 house, they get paid exactly the same way. Now, obviously, that's done strategically so that I treat every client exactly the same. Right? So the level of customer service never falters based off of what price point that client's looking at. Because me, as I'm handling the consumer directly, I'm not motivated by what I might be getting paid as a result.
Cool, thank you.
I hope that answers your
Yeah,
question.
definitely.
Hi everybody, my name is Claire Diamond, and I'm a private wealth advisor with Casimir Capital Management. One of the interesting things about working for an independently owned firm, such as Casimir, is we're not tied to any sort of investment products, which is a key differentiator between most brokerage firms and an independent firm. The advice that we give, is rooted in being completely unbiased and non-conflicted, just because we're not tied to selling any kind of products. One thing I think people should always look for in an advisory team, which we do, and I'm sure Isaac does, and all other brokerage firms, is we provide an enormous amount of other services outside of just investment management. So as you move forward and look for an advisor or an advisory team to work with, those other services tend to be just as important as the actual investment management. the way that we get paid as an independent brokerage or as an independent firm is we run 99% of our business on a wrap advisory fee basis, which means when you join our team, you pay a percentage-based fee based on the assets that you have with us. So if you have $100,000 and your fee is 1%, that's the annual fee that you pay on those assets. An interesting thing that most advisors will do is, they charge you on the assets that you have, but speaking to the services that I was just mentioning, a good advisor is also going to speak with you about your estate plan. They're going to speak with you about your 401k. They're going to speak with you about your 529s, which might not be under that management, but that's kind of the benefit to that fee. It's purely transparent. You know what you're paying, and your advisor, or most advisors now, will kind of take that all-encompassing view of your total financial picture, just charging on the assets. So that's kind of where the fee negotiation would come in, I'd say, when you're speaking with an advisor who's charging a fee on your assets.
Justin, we don't need to know how you get paid. We're more interested in how you get money from your investment properties.
You're assuming I make money?
Well, that's why you're up here. I hope you remember it. But.
So Justin Bresson, I am an agent at Keller Williams, and I have a team, Fresh Places, and I get paid through selling and buying and selling real estate. I take that money and then I buy my own real estate, and I don't actually really get paid through that. I take the income from rental properties and I put it back into the business, and I use that to fix up stuff, add value, and buy more real estate. So I don't touch that money, so I don't think it's
We'll get more into that later. Yeah. Alyssa.
I'm Alyssa Chapnick. I'm with Finance of America Mortgage. I'm a residential loan officer, so somebody's looking to purchase a home, I will pre-approve them, and then at that point they'll work with the real estate agent to find the dream home. I get paid 100% commission. How that's translated to the buyer, it's just a flat fee on any kind of refinance, any purchase. It's called a processing fee, and that just helps pay, the processor, the underwriter, everybody that has their hands on the file trying to get it to closing.
Is that a percentage of the deal?
No, so it's a flat fee, doesn't depend on the size of the deal.
Great. So we had introductions. I do have specific questions I'm going to ask, so I'm hopeful that I'll answer a lot of things that you have questions about. And if not, then we'll try to get to them at the end. Okay, so Isaac, we'll start with you. Why is a financial planner important, and when should someone seek one out?
Yeah, for sure. So, in all honesty, I think finding a financial planner as soon as possible is key. One thing that I tell my clients is we put together plans for people for $50,000 a month, and we also put together plans for people for $100 a month. There's never going to be any point in time in your life where there's this light bulb that goes off that, okay, now's the perfect time for me to start planning. If you have 20 things on your checklist of things to do and you can check off 2 or 3 of them, that's going to move you in a better position for next year. And anybody that's doing comprehensive planning is going to meet with you on a semi-annual or at least annual basis to sit down and make sure, hey, what we put in place last year is still doing what we want it to. It's not like I meet with someone, it's like, all right, well, good luck. I'll see you at retirement. Let me know how the next 40 years goes. So, right, we're sitting down with people regularly to review, and any steps that you can take are critically important. And the power of compound interest is also incredibly important. It may not seem like $100 a month is going to make that much of a difference in the grand scheme of things, but if you start that at age 22, 25, 30, as opposed to waiting until 55 and you can save, right, $5,000 a month, it's going to make a huge difference in the grand scheme of things. And then also, it just gives you clarity, right? So why I meet with a financial planner is you get to talk through the goals that are most important to you and create a game plan of how do we get from point A to point B most effectively. Even if it's not something that you can address today, at least you're going to have some, like I said, clarity in regards to how do we move the needle forward.
With that, talking to a financial planner, obviously there's an interview process. Like, how do you go about interviewing a financial planner, finding someone that makes sense for you, and how do you know? How do you vet this person?
Yeah, no, for sure. So, because I sit down with a lot of people all the time that are working with another financial advisor, and the thing that I tell everyone is that trust is the most important thing with the financial advisor. If you have somebody that you're working with that you trust. I tell people all the time, like, I'm not here to step on anyone's toes. If they're doing a good job, and we'll double check things, right? But if they're doing a good job and you trust them, keep your stuff with them. If again, that's the relationship that you have. But any good advisor, similar to what Claire was alluding to, is like they're going to look at everything. It's not just about making $1 grow to $2. That's obviously a critically important component to a financial plan, but making sure that it's growing from $1 to $2 in the most tax efficient manner and how everything ties in is critically important. So you always want to make sure you have somebody that's driving the ship, right? I have some people that, well, I have this guy that manages, or this person at work helps with my 401k or whatever the case may be, and then I have an accountant over here, an attorney over here, or whatever, but there's nobody that's like helping do all the planning. Having somebody that's making sure everything coincides. It's like any sports analogy, right? You could have the best player, but if all the teammates don't work together, then it's not going to be as successful.
Sure.
Did that answer that?
Yes and no.
Okay, cool.
The
Keep
follow-up
going.
to that is, what specific questions would you ask to make sure that someone is qualified and capable of managing your money, whether it's $100 a month or $50,000 a month?
For sure, yeah. So I think you want to make sure that someone takes a comprehensive approach, right? The first meeting with a financial advisor, in my opinion, at least how we do it, is to sit down and just have a discussion around what's most important to you. It has nothing to do with talking about products or solutions or anything like that. Because if someone asks, hey, Isaac, what should I do with my money? Well, it's impossible for me to tell you what to do without knowing what's most important to you. So they should certainly create a personalized plan for you specifically. It shouldn't just be, okay, well, I like XYZ fund and that's what we're going to invest in, or hey, this is a blanket solution for everyone.
Is there a place to check up on their capabilities?
For sure, yeah.
How much return they're getting? Is there ratings on how you pick a financial planner? Like some are rated better than others? I don't know. I'm just asking, is there like...
There's an advisor check, right, where you can look and see if anybody has any complaints against them. FINRA, do you know the website, FINRA advisor?
Yeah, it's broker check.
Broker check, yeah.
Okay.
FINRA broker check. So you can look and see if they have any complaints against them or if they've done anything illegal in the past. Those would be people, obviously, to
Sure.
avoid. I think as far as planning is concerned, there's a lot of different designations in our industry. So basically, if people have letters behind their name, it means that they've taken some tests
Sure.
in regards to how financial planning works and how it all ties in with itself. So I would look for somebody.
So extra
presumably-
letters, got it.
Yeah, letters are good behind someone's name. It just means that they're
Sure.
more going to do a more comprehensive plan than just the basic. Again,
Okay.
hey, I'm making $1 grow. And again, I don't want to downplay that. Is critically important.
Sure.
But the fact of the matter is that rate of return is also based upon your overall risk tolerance, right? So if someone is just looking at like, well, my neighbor made 10%, I only made 6%, my advisor is not very good. But they might be in all equity funds. You might be a much more conservative investor. So like rate of return is a difficult thing to base things on. But that being said, if they're clearly underperforming, that's an issue. But that's a tough one to judge things off of, I would say. More so important than that is does the plan make sense? Are the things that they've laid out for you realistic? Like, is the rate of return that you're showing you, given the investment asset allocation that you've selected, is that realistic, and are they hitting that goal? That is more important, I would say, than just are they the highest performing asset class
Sure.
that given year.
Okay, so extra letters behind their name is the key factor there. All right, Gordon, tell me about best practices of bookkeeping. Like, I'm new to this. I made my first commission check. Woohoo! What do I do?
So you want to do something there. We typically, I would say, we advise a lot of our clients to use QuickBooks Online. It's come a long ways since I started in accounting. It was not good probably 6 years ago. When I got back into public accounting, it's made total strides, and they're making strides today. They do have different plans, but honestly, if you're just starting out, you can get the most basic plan. And what's great about it is you can link up. Well, I'll also say, make sure open up some business accounts, whether it's credit cards. Credit cards might be a little bit harder to get, but you can definitely open up a bank account. So start with that. In the business's name, you might want to establish an LLC. So talk to a lawyer. We don't necessarily do that kind of work, but we always direct our clients to go to a lawyer to maybe establish some sort of LLC business. But then at that point, once you have all of that established, you can create this account. You can link up your bank account right away, and it creates everything for you right there. You can tailor, hey, I'm spending money on this, and you can create accounts where you know what you're spending your money on. And it does most of the work for you. All you really have to do is say, okay, this is where my money is coming in, so this is a sale, this is revenue, so you have your revenue line, and then anything that you're spending your money on, you can tailor it to that. You can create accounts to show that. And that's kind of where we like to come into play and see, hey, you're spending your money here instead of, why are you spending so much money here instead of there? And we just kind of advise a lot on how our 1099 clients are spending their money. And then, you can run monthly P&L so you can see your growth trends and things like that. But I would definitely say don't wait until the year is over to then kind of compile all this stuff, because that's where things are going to get lost through the cracks. You might sit there and say, oh, well, I spent that business expenditure with my personal credit card or my personal card, and what'll happen is over the year you're going to start to forget. You're going to think, oh, did I need a receipt for that? Did I not need a receipt for that? With everything kind of being online these days and being able to link everything up like that, it's just a lot easier to track and to really know what you're spending and not have to remember. So I would definitely say do it right away. Don't wait until the end of the year.
Are there quick categories you can shout out that I'm starting
Yes.
out, I need to these 4 categories I should put things under?
So definitely depending on the business that you are, but generally speaking, you might be traveling to other clients, to other locations, so there's travel expenditures. One of the big things that we tell people to track is their auto mileage. There are apps out there that helps you track your auto mileage. So anything business related that you're meeting with clients, you're driving to different locations, you can literally, I think one of them is it's called Mile IQ.
Mm-hmm.
That might be one of the apps. Basically, when you're saying you're about to drive somewhere business related, just plug it in then, and then plug it, turn it off once it's not business related, and it'll track your miles for you. I think in 2019, for every mile that you drive, you get 58 cents of a deduction on the dollar. So you definitely, that's a bigger thing. Travel expenditures, other things are like hotels. The IRS changed. It used to be meals and entertainment. Now it's just meals. It is a 50% deduction. But then, office expenditures, dues and subscriptions, anything that licenses, anything that you have to apply for your job. Keep track of it. You can just run it right through your business card. It'll come straight through, and then you'll be able to see it. And then, every good, valid deduction that you take will help you come tax time. One thing that I always tell clients is don't be egregious. If you're sitting there, you are doing something. It really, a lot of it always comes down to the meals and entertainment part. And if you have to ask yourself, is this deductible or not? A lot of times it's probably not. You have to ask yourself. Nowadays we have Google. You can always, if you're by yourself, you can always Google it to see. But generally, you just don't want to be egregious with what you're putting on business cards. Because the IRS will look at it and they'll say, okay, depending on what your business is, if you have a ton of expenses in one category that totally doesn't match with your business, it's like a red flag right there. So you want to be honest. You don't want to be too egregious by the end of the year, and then and then you're good to go. And for us, as accountants, we're able to link into all of our clients' QuickBooks accounts too. It's a separate login for us, so we can make changes. We can actually record things for you. Like a lot of our bookkeeping clients, we use our accountant, it's QuickBooks accountant. I can go into the client's books and record things, but I can't do anything like billing wise or anything, or even finance wise where I can see their bank information and things like that. But definitely get it started right away. Don't wait till the last second, because then at the end of the year, it might be a pain for you, it'll be a pain for the accountant, and then things will fall through the cracks for sure.
Just one quick question. What should we be doing to reduce the amount we pay in taxes? Is there like one quick thing you'd be like, everyone should be trying to do this?
One quick
No is
thing.
no pay answer. Just we're trying to reduce our taxes. Is there some quick and dirty thing that you think everyone should do?
So it depends. I could get into the weeds a little bit, but one philosophy that we have some of our, like, as you're growing, and usually if you get to a certain net income level, a lot of our clients, we will suggest that they become an escort. And so 1099 employees, you pay that additional 15% self-employment tax. And it can hit you kind of hard at times.
At what income level do you get to an escort?
We say, so like for our firm, because our fee will increase for that client. So if the client's with us, the fee will increase because we'll also charge for that additional tax return that we would have to do. But it depends on the accountant that you're using too, and how that might increase for you. But basically, we usually say if you're netting around 60,000 in the year, 50 to 60,000, would be a good time for you to convert to an escort. And the benefits of that are that you can take a salary. And the other cost that comes with taking a salary is you might get set up with a payroll company that'll charge you, $50 to $100 a month to process your payroll. So you'll have a few additional fees, but it'll save you because basically when you take that salary, the rest of the income that passes through to you is not subject to that 15% self-employment tax. And this is only if you're an escort, but that's definitely a huge strategy that we try to preach to a lot of our clients. If you think that you're going to be at a certain income level, you can convert. And if you're a sole prop, you have to probably establish an LLC first. But if you already have the LLC, between January and March of the beginning of the year, we basically fill out a form, we send it to the IRS, and then they'll convert your status to S-Corp status. And then at that point, you can start taking the salary. And we usually say take the salary, again, like you don't want to be egregious with taking that salary because the IRS, on that salary, you're still paying the 15%. It just, you get the deduction to the business. So you don't want to be egregious. The IRS basically says, pay yourself what you think someone else who came in to replace you would get paid. So don't pay yourself 100% of the profits. If you fall between 50 to 70%, you're probably okay.
Cool. So don't live fat, that's important to us. Jake, what do you wish young professionals knew about credit? Well, and the general public in general.
Credit. Wow, I can speak all day about this. I guess there's three major things that I want to cover, right? What goes into a credit report, how's it calculated, and how's it used. So number one, what goes into it? Not everything that you do, not every expense that you have is in a credit report. So things like phone bills, utilities, cable, that stuff's not in your credit report. Right? Credit report's going to be installment loans, student loans, mortgages, obviously, credit cards, car payments, all that stuff, right? So each one of those creditors that you have that's maintaining your information, your payment history, whether you have lates, different stuff like that, is reporting to the different bureaus, right? The three major bureaus, which is Experian, Equifax, TransUnion, right? So I guess then to jump to the next point, it's how do I come up with my scores, right? This person's telling me my score's this person's telling me my score's that, who do I listen to? How do I know? I have no idea. This is really frustrating is commonly what I come up against nearly 2, 3, 4 times a day, right? So basically all these creditors funnel their information to FICO, right? And what they're reporting to FICO and to these bureaus is not all the same, right? So if I have a car payment, chances are I have all three bureaus reporting that trade line, right? But it doesn't mean that I have all three trade lines going to report, right? I might only have Experian or TransUnion, or I might only have Equifax, right? It depends on the trade line, right? However, all this information funnels to FICO, and they're calculating what your scores are, right? Well, what is FICO? It stands for Fair, Isaac, and Company, right? So what your scores are really based off of when you get a legitimate report and not a consumer information report that's coming from like a Credit Karma or something like that is Fair Isaac's algorithm, Right? So they have an algorithm that's taking all this information, compiling it into a system, and calculating scores and weighing it upon what they weight the most. There's a hierarchy, so at the top of that hierarchy is going to be mortgage, and it's going to be student loans, and it's going to be I think it's car, and then it's credit card lates. Gosh, I can't remember below that, but that's all based off of what's going into that algorithm and how it's calculated, how to weight it, right? So to put this back into layman's terms, all that information goes into a calculation, spits out your scores. For a mortgage, you have 3 scores with the 3 major bureaus. If you're qualifying for a mortgage, I take the top score, throw it out, I take the bottom score, throw it out, and then I base it off of the middle score, right? That's how you come up with that information. So when you're looking at a Credit Karma, or whether it's a CreditWise, any of that stuff, it's not going to be necessarily accurate because all these consumer informational bureaus are going to have their own algorithm. It's not going to be Fair Isaac's algorithm, right? It's going to be based off of what they have. So their scores are going to be a little bit more generous, if you will, than when you go to apply for a mortgage. So the most frustrating point of a mortgage application or a pre-approval is my scores are telling me that I have a 760. I know that that's great credit. Why are what you're telling me that my score is a 700? Well, simply the algorithms just aren't the same, right? The calculation of how we're getting to the scores are completely different, right? So obviously that's a barrier that we need to break down and help to educate consumers. It's commonly what I educate consumers on the most. But that's the nitty and gritty of it, and I apologize if I went too much into the weeds there. Last point, how is it used, right? So obviously you apply for a credit card, you apply for a car, you apply for a mortgage, it's being used that way. What a lot of people don't realize, regular consumers, what they don't realize how it's used is, if you go to apply for a job, I would say 60-70% of employers are going to look at your credit. The credit, your credit report is going to tell you a lot about you, right? How good are you with managing your payments? How organized are you, right? A lot of indirect things that are being spoken about as a result of your credit history that a lot of people don't look at. Another thing, you want to rent a house, a lot of landlords or a lot of smart landlords are going to want to have a credit report. They want to see how likely you are to repay your rent, right? They have no other idea. They don't know you, so they want to get a good indication for, hey, how likely am I to collect your rent? Another example, insurance policy, insurance company. You want to go get a car insurance policy. If you had a 30-day late on your mortgage 2 months ago, you're going to have a pretty difficult time getting an insurance policy for your car, or it's going to be extremely expensive. So, just a couple of different ways that it's used besides just applying for a line of credit or car or mortgage, stuff like that traditionally.
Are there any myths around credit that you hear all the time that you wish people knew better?
Myths?
Yeah.
No.
No?
No, I'm just kidding.
Myths.
Myths, gosh. So to go back, the biggest by far myth is why are my scores different than what I'm seeing on CreditWise, which is like I have Wells Fargo, so like when I go on, they're going to give me a CreditWise report. They're going to report that. Or like a Credit Karma is obviously the most common one that I get, and I've already kind of explained that. Myth number 2, I would say, is the biggest one that sticks out to me. A lot of people think that their job is tied to their credit report. You could be homeless and have an 800 credit score. Chances are that you find a homeless person with an 800 score is low because you probably trashed your scores prior to you becoming homeless. But you can make $1 million and have, which is obviously, or not obviously, it's actually incredibly common. Professional athletes have trash credit just because they think that they have so much money, credit doesn't matter. Then they want to go to purchase a multi-million-dollar home, and they don't qualify. They're like, I make all this money, why can't I qualify? It has nothing to do with your job, your income. It just doesn't, unfortunately. Third, those would be my 2 biggest ones. I don't know if anybody wants to shout out, maybe what their thoughts about credit. I can tell you about a myth about that, but that's primarily what I was thinking of.
Paying off all your credit improve your credit score?
It does not. So actually that kind of opens up 2 things. Number 1, I would say that the biggest one that I miss is people think that paying all your bills on time is just going to give you excellent credit. That's not the case. 65% of your report of what goes into your credit has nothing to do with your payment history. You're asking me if you pay stuff off, right? If you pay down credit utilization is a huge piece, right? So if you're maxing out your credit cards, but you're still making your payments on time, it's hurting your credit. you want to stay around 30% or less. If you pay off an installment loan, right? Let's just say that, God forbid, family member passes away, you get some sort of inheritance. Hey, I'm tired of having student loans. I have 50K of student loans. I just wanted that to disappear. You pay that off, hurts your credit, right? It's one of those things that it's another trade line that's showing folks your ability to repay on future trade lines. So if you eliminate that you no longer have that history. So that actually hurts your credit.
So you want to keep your revolving credit around 30%?
Around 30%.
Cool.
So would it be smart to ask to increase your credit lines, but not increase the credit you're
Right.
spending?
So that's
because that lowers your.
Absolutely. So that's an opposite way of thinking of it. It's just if I keep my balance the same and just ask for an increase, and then that lowers what my ratio or what my utilization is, same effect.
I have one question about that. How about multiple credit cards?
I'm honestly, I'm a younger guy. I'm in the process of building my credit up just because I was the type of guy in college. I don't like spending the money that I don't have. I don't like doing that. But I have such a lack of history of credit. I've only been building credit for 3-4 years, so people aren't going to be willing to increase my credit limit. So my solution to that was get a couple more credit cards. Get a couple credit cards. I just threw $100 gas every month. I had like a $500 limit on like 2 or 3 different cards. Leave it at $100 a month, and unfortunately, it stinks to pay the interest on that. But that's the cost of building my credit. So that's what I did, and that's what I continue to do. So as I build more history, I'll either take out another card or I'll increase my limit.
Cool. Thank you. Claire, can you define wealth? I know it's weird, but
Yeah.
when you're thinking about like Isaac said, there isn't a dollar amount that makes sense to get into this, but there's a difference between financial planning and wealth management. So what is that defining tipping point that makes sense? And if it's not a fair question, you can say that too.
I wouldn't say it's not a fair question, but when I think about wealth, I honestly don't really think that you can put a numerical value on it, because if you ask me what's wealth is the freedom to be able to choose what you want to do with your time. It's being healthy. It's being able to choose to retire a little bit early, spend more time with family, buy a second beach home, travel. And I think that the definition of wealth is going to vary from person to person. So I don't really think that I can define what is wealth, but one thing that I think Isaac and I would both agree on that you can define is whatever your opinion of what wealth is, there's a definite definition and a way to achieve it. And that's just through accumulation. I think most of the people in this room are kind of in that same stage of wealth accumulation, trying to get to a certain point where they feel comfortable posting at a later point in their life. An analogy I heard somewhat recently that I think is really applicable to this situation is if you think about a plane taking off for flight, the hardest that a plane has to work to get to its destination is on the takeoff. So when you think about wealth accumulation, you start here and you're trying to get to here. The hardest part is this part. So with an airplane, the most amount of power and technical engineering and everything like that goes into that ramp up to get into the sky. And once it's reached its altitude, it just kind of coasts. It's not really, there's not much maintenance. Pilots can kind of take their hands off. And that's more what I would think about in terms of defining wealth. Without question, the period of accumulation, when you start it and the sooner you start it, the more beneficial you're going to be at a later point in your life. To that, I've also worked with clients, kind of through all life stages, and people that have accumulated wealth for years and years. And it's not like they just all of a sudden wake up and be like, I'm wealthy. But it's more, they kind of reach a point where they're like, okay, I can back off a little bit from work. I can take an extra vacation. I can travel this far. So I think more of the focus in defining wealth would just be the process that you go about to accumulate it. And honestly, coming to meetings just like this is an amazing first step in doing so. To touch on what Isaac said, if you're saving $100 a month for 12 months, that's $1,200. And then that compounds over years and years, and then all of a sudden you can save $200 a month, and then it's $500. And if you're starting that now, the compounding effect is absolutely incredible. I actually recently met with clients who were both teachers, made very modest salaries, kind of out on the main line, and they have amassed a tremendous amount of wealth by just being really good savers, little spenders, and they've stayed disciplined to the track that was set in front of them with, our team. And, that discipline factor, it definitely comes into play. And by no means am I saying, take every little bit of extra income that you have and just put it away, because you still have to live your life and enjoy it. But it's just getting into that mindset of, okay, I'm just gonna systematically put this away. I'm not gonna look at the market. I'm just every month gonna put $100 into an investment account. I'm still shocked. I'm sure you'd say the same thing when you see things, how they compound over years. It's just so beneficial to start younger.
When should someone seek your services?
I think whenever you, as an individual or as a couple, have some discretionary income that you have to put towards a goal, I think a conversation with a financial advisor is warranted. The worst thing that an advisor can tell you is, hey, you're doing great, you're on the right path. I don't think that you've quite reached the point where you need the services of a financial advisor. You don't need to be paying certain fees, but here are the steps that you should continue to take so that in a couple years you are ready to take that next step and build a more comprehensive plan. And I think to kind of touch on that question and what we were speaking of before, when you're thinking about approaching a financial advisor, of course there are a lot of questions that come up, but you also want to make sure that the advisor that you're seeking is the right advisor for you. A good advisor will be able to tell you the type of clients that they work best with, because no advisor can work well with every single client. And I think that that's just an important thing to consider as you are searching. You want to make sure that the advisor that you're working with works with clients like you and wants to continue to build relationships, with people like you. So,
that's great. Yeah. And for your financially healthy clients, what's one common trait that reoccurs in all of them?
Okay, well, this isn't one, but it really all kind of leads into one. I would say my financially successful clients start by having very clearly defined and articulated goals. If you think about kind of like a house, that's the foundation. Clearly defined and articulated goals is so important to getting started, in your financial future. My successful clients, have efficient savings plans. And that's not just necessarily, I'm saving $100 a month. What type of vehicles are you saving in? Are you saving in the right retirement vehicles? Are you utilizing 529s or investment accounts the right way? Financially successful clients prudently manage risk, not necessarily just market risk. When you're looking at someone's total financial picture, Isaac touched on it kind of in the beginning, insurance is kind of the thing that can make that house of cards fall. You really want my financially successful clients have prudently managed risk if something were to happen catastrophically to them or to their plan. And then I think, the last thing that's really important is successful clients have thoughtful organization to their plans. I can't tell you how many people I meet have a bank account here and an investment account here and then a savings account that I think my mom started for me once, and then I think I have this insurance policy. In really successful client relationships that we have, people have their plan almost organized into silos. Here's my banking. And not necessarily you can only use one bank, but I have everything aligned with my banking and everything aligned with my investments and, my real estate, and both in, if you needed to just pull statements or just get an estimate of your total net worth, being organized is extraordinarily important. And then I would say through thoughtful organization within households among couples, I've seen a lot of success when both spouses are very aware of how a couple stands financially. Both spouses are involved in the decisions. You know, it's not to say that I certainly work with clients where one does more than the other, but it's just so important that both people are on the same page. And then lastly, with organization, a lot of things people don't think about when they're our age is estate planning. Because, you know, we're also young and we just don't really think about that. But really, with an estate plan, if you have assets and you have the desire to make sure that they pass on to your loved ones in the way that you want them to be passed on, you need some kind of an estate plan. It can be the simplest thing, but that's, you know, I would say kind of the last pillar there. And then like what brings it all together is just discipline. And I touched on that before, but again, I'm sure Isaac would agree, a lot of what a job of a financial advisor is just to be a coach and help you just stay on a path that you've outlined for yourself to continue with the success that you are trying to build.
Cool. So accountability partner for sure.
Yes.
All right. Justin. So I just like giving you looks. What's your investment theory or strategy? I guess like more so like, I think the bigger first question should be, how did you get your first investment property? Like, what was the plan behind it? Was it like on a whim? Did you plan for this? Like, how'd you get there?
So my first investment property was 1908 North 8th Street. I was a tenant. I had 2 roommates, and it was like in really bad shape. And I kept nagging the landlord and the property manager, like, fix this, fix that, fix this, fix that, and they would never do anything. So then eventually I was like, well, maybe I should try and like, buy the property. So I asked the property manager to ask the owner if I could buy the house after like at least 6 months of like complaining about everything. And they said, give me a number, so we like negotiate back and forth, and I bought it. I got a mortgage, and I instantly had my roommates now, instead of paying our landlord rent, they were just paying me rent. So like literally from day one, I didn't come out of pocket for any like mortgage payments. I fixed it up and I refinanced it and took my cash out of it.
So with that, have you developed a philosophy, a strategy, a theory into how you invest?
I mean, it's very unique for everybody, so like I can share mine, but that doesn't mean that it applies to any one other individual. I think that I look for value add opportunities that are going to be income producing. And I don't like to buy anything that isn't going to cash flow.
Sure.
I think that the biggest thing that I have control over is what I pay for the property. So, you know, what it refinanced for is going to be appraised. What it costs me to fix it up is going to be, I'm going to have limited control of that because the contractor picks that. But what I purchased the property for, I have complete control of. I can negotiate it down. I can choose to buy it or not buy it, depending on what it is. So that is the most important aspect to me.
Were you an agent when you bought your first property?
Yes.
Yeah. Okay. Can you tell everyone why that's an advantage?
I think I just was aware of the market, I guess. I think actually buying my first property helped me as an agent because I'm telling all these people to buy houses and I've never owned a house.
Sure.
And buying my first house, you know, I can kind of speak to it.
Is there something you wish you had known about investing when you first got started? I mean, you were working with clients, so you probably learned a lot along that path. But when you got involved yourself, is there something like an aha moment or something that jumped out at you?
Don't hire contractors off of Craigslist.
Oh, that's a good one. It's a shame you got to learn that way.
And I think that the first one's really, really hard. And after you get through the first purchase, you take a big deep breath. So like maybe I could have like jumped in a little quicker.
You mean for your first one or the one after your first one?
For the first one. First one in theory, I think, but yeah, for the first one.
Sure. I don't think I've ever met someone who bought their first property and was like, glad I did it now and not sooner.
Yeah.
Like everyone's like, oh, I should have done it 2 years ago. But
Yeah.
Anyway. What was that? What's that?
I said I was groundbreaking.
Well, you know, that's what I'm here for, you know. What was the first steps besides buying the first one to build the investment portfolio? Like, did you get like a number in mind to save for a down payment? Did you have a strategy of like, okay, I want to get this many in this amount of time? Like, was there any rhyme or reason to the plan, or just kind of
Someone told me 2 a year,
2 a year?
and then so I was like, okay, that sounds good. And it's the value add, right? So it's like I always think about it, like I'm using the same money that I used in 2011 to buy the properties I'm buying today,
Sure.
because I'm just refinancing and taking my cash out.
Sure.
And it's how can you be economical with it. So like for the first like 2 or 3 properties, I was like tiling floors and bathrooms, and I redid like a whole bathroom in this property in Fishtown, and people liked it. That's like the first time I ever did a tile surround, and like the last time I ever did a tile surround. So did that answer the question?
Sure, I think so. I have more for you later.
All right.
Alyssa's going to focus on student loans because I think, how many people in here still have student loans? Okay, a decent number, and some people are probably scared to raise their hand. So, double hands from Stacie. How do income write-offs affect how an independent contractor can qualify for a mortgage?
So first, does anybody know in the audience how do you calculate income for self-employed for a mortgage? Okay, so what we use to calculate income is we'll use 2 years in average. Because you don't have like a steady paycheck coming in, we can't use your pay stubs, can't use your W-2. So what we do is we take 2 years of your net profits. So how write-offs can impact that is typically you go to a CPA, you say, I don't want to pay a lot of taxes, what do I have to do to not pay taxes? So a lot of people will have a ton of write-offs and their net profits are very small. That way they don't have to pay a lot of taxes on it. When you're applying for a mortgage, that can negatively impact you because now you don't have a lot of net profits that we can use to qualify you. So it's kind of like a catch-22. You kind of have to find like the middle ground. How many expenses can I have while still being able to purchase a property? Versus, not taking enough expenses, being able to purchase, but now you owe a lot in taxes. So what I say is if you are planning to purchase a property in the next, let's say 2 years, 1 year in the future, I would say link a lender with your CPA and ask, how much do I have to have in order to purchase a property for, let's say, $250,000, $300,000? And that way your lender can work with your CPA and get you to net profit exactly what you need to purchase the property that you want. So it's kind of like working a little bit backwards to have a smoother transition and be able to purchase when you want to purchase.
It's huge. I said student loans, so I should probably ask you about those too. What are the best practices for managing student loans and when you're trying to qualify for a mortgage?
So first, it might be obvious, pay your student loans. A lot of times people think that they don't have to pay them and that it won't affect their credit, and it absolutely will. So student loans can stop you from purchasing a property in themselves, but the way that they do impact it is it'll impact your debt to income ratio, and it'll also impact your credit. So like I said, definitely pay them on time. And the second thing is, so we look for debt to income ratio in qualifying. So what we look at is your monthly debts, and we add the projected monthly mortgage payment divided by your monthly income. So when you have student loans, it'll impact the ratios. You'll have a little bit higher debt. So one way to get around that is a lot of people will refinance their student loans, clump them all together, and you typically will have a lower interest rate and a lower monthly payment, which leaves a little bit more wiggle room for your mortgage. Another thing that a lot of people do is they'll have an income-based repayment plan, which again, typically will just make your monthly payment lower, which leaves more room for a mortgage. So again, just planning in advance. If you know that you're looking to purchase a home, look at different options to get your monthly debt lower.
Question.
Yeah.
What do I do if my loans are in forbearance or deferment?
Thank you. So a lot of times when people's loans are in forbearance or deferment, meaning that they're not making payments on them, They think that that won't impact their debt to income ratios, which is actually incorrect. So if you're not paying on your student loans currently, what we do is we'll take 1% of the student loan balance. So just for example, let's say you have $30,000 in student loans, we'll take 1% of that, which is $300 a month, and use that to qualify you. So sometimes when you're not paying on them and they're in deferment, it's actually worse than if you're paying on them. The student loan payment will be higher.
I'm going to open it up to questions, but I think the general thing that everyone is saying up here is don't be afraid to talk to someone and ask questions, right? Like, everyone up here wants your business, except for, well, Justin too, but you shouldn't go to him. There's plenty of other realtors. But everyone up here wants your business, and the lenders want to give you money, the wealth managers and financial advisors want to help you make more money, realtors want to help you get into something that is investment or gets you closer to your goal of purchasing your first property or starting that investment plan. Everyone is here to earn your business. So if you talk to them, it gives you an amazing target to set. So you talk to a mortgage person and they're like, no, not today, but here's how much and here's how and here's what you should do to get there. And you talk to your accountant and they're like, okay, we want to buy a house, let's manage what our write-offs are. We talk to a wealth manager and they're like, hey, you know what, if you get to this point, come back to me and here's what we should do and here's some steps to get to that point. So really taking all of this as a learning platform and then kind of making a plan from there. Even if you're not ready today, it really gives you a launching pad. So thank you all for your information. Someone back here, where did you go?